Hello friends, here we will start the module D of Advanced Bank Management, overview of the credit management. So in this module D is all about your credit. Here we are going to discuss all about the credit and advances and what are different limit, especially in this chapter we are going to discuss what are different limits for the priority sector, what is a priority sector advance, and what are the limits set by the RBI for the priority sector. That we are going to discuss majorly in this chapter. And first chapter of this advanced bank management is all about only figures. You have to note numbers. There are some numbers which are set by the RBI, as a mandatory, that you have to note. Okay, so first and concept, the basic concept of a credit management, that is a overview of the credit management. Here we will get clarify. Okay, so let's start with the credit management. See, credit is a contractual. What is a credit? Credit is a contractual agreement in which a borrower receives something of a value and agrees to repay the lender at a later date. That means you are receiving, suppose 100 lakh rupees today, and you agree that I will repay in the period of 3 years span. Okay, so basically this is simply the credit. We all know basics of credit. Credit can be defined as the borrowing capacity of an individual or the company. What is a credit? See, for example, credit card. You are having credit card. Credit card is having some limit, right? Say you are having limit of 1 lakh. That means this is the borrowing capacity of you without a collateral. There is no collateral on the credit card, right? That means basically, see here, credit is nothing but the borrowing capacity of an individual or a company. If you are giving loan to the company, it is the borrowing capacity of the individual or a company. Okay, now what is the importance of the credit? Why we are giving credit to each other? Why we are giving loans to the different customers? Why? What is the importance of the credit? See, very important that credit is a vital and a important factor in driving the national economy. We all know, for example, say you are a very good person, and you are having very good business ideas, but you are not having sufficient money to start the business. Okay, so what you can do? You cannot implement your ideas, right? That's why there are banks, there are financial institutions which give you a credit or in the form of a loan. Okay, and that's why you can start your business, you can earn more, and that will definitely contribute the GDP of the nation. So, and that will also generate the employment. So basically credit is very important in case of the national, for driving the national economy, as is it generate the employment. It also help to boost the GDP and the growth of the nation. That's why credit is a very important and the vital factor. Okay, now the availability of a credit helps in what? The availability of the credit helps in when what is the importance of the credit? Because it accelerates the industrial production and services. Definitely, when you get a loan, that industry can be expanded, better services can be provided, right? Purchase of assets and repay loans from their future earning. You can purchase asset by the way of a loan, and you can repay that from generating whatever the income you are generating from that asset. You can repay that loan. This is especially useful for entrepreneurs, and a credit, that is a loan facility, definitely very useful for what? For the entrepreneurs. Credit helps individual to spend more than what they could otherwise spend, right? That means if you are having 1 lakh rupees, if your credit facility is able to spend more, if you get 100 lakh rupees of a credit, then you can spend more than whatever you are having. Basically, simply credit helps to individual to spend more rather than it can otherwise he could spend. Okay, basically this is a simple basics basic concepts about the what is the importance of the credit. Okay, so here we have discussed a very basic what is a credit, we have discussed what is the importance of the credit that we have discussed. Okay, so just this is for your just clarity about the credit. Now what are the principles of the credit? See, there are certain basic unwritten policies for lending that have been evolved by the banker. Loan policies and other aspects of credit management are influenced by principles such as, what are the principles of the credit? See, safety of the fund. Whatever the loan you are lending, there should be having some safety. What is the purpose of that loan which you are giving? What is the profitability? What the profit you are generating by giving the loan? What is the liquidity? When you give the loan, then your money you will not have a sufficient money to lend to other. Then liquidity also is one of the important principle. What is the security you are having against that loan? And what is the risk spread? Means what is basically you are earning the net interest. Okay, so these are the some principles of the credit. You just go through the names. There should be, see, it is very easy. The safety, then purpose, profitability, liquidity, security, and a risk spread. Okay, so safety of a fund, second purpose, third profitability, fourth liquidity, fifth security, and the sixth risk spread. So these are the some basics principles. You don't need to go in detail of that. Just go and if possible, just remember the names. Okay, you don't need to go in a detail. Now we will start the actual and important part of this chapter. Types of the credit. See friends, what are the types of the credit? There are basically only two main types of the bank credit. First is the fund based and second is the simply non-fund based. So this type of credit involve an actual transfer of the money from bank to the borrower. See, name itself it indicates that fund transfer, it is a fund based, means actually money has been transferred from bank to the customer. In this type of credit, actual transfer of the money takes place from bank to the borrower. So the different kind of a fund based credit include, for example, say working capital finance, you are giving money to the customer. Project finance, you are giving money to the customer. Export finance, you are giving money to the customer. Crop loan, you are giving money to the customer or the farmer. Okay, so these are the example in which we are actually transferring the money from bank to the borrower. So remember, in case of fund based, we disburse the loan. We disburse the loan. What is a fund based? Where we disburse the loan, in simple words. Okay, so see, and if it is based on the period, we can classify that a fund based credit like a short term credit or a long term credit. That also we can classify. Now what is the non fund based credit? Simply it is just a vice versa of a fund based. This type of credit involve no actual transfer of money. Here there is a no transfer of money. In fund based, name itself it can, you can easily come to know. Non fund based means simply no transfer of money. Okay, rather bank makes a commitment on behalf of a borrower that may result the transfer of money to the beneficiary of a commitment in a future date. So here, for very first, what you have to remember, see, non-fund based credit means here there is no transfer of money. First, there is no transfer of money. Okay, so what is the example? What are the example for the non-fund credit? See, bank guarantee, we are giving the guarantee, but we are not giving the funds. Letter of credit, we are giving the credit of letter of credit, but not directly fund. Co-acceptance of the bill, forward contracts, derivatives. Here actual transfer of money from bank to the customer is not involved. That's why it's named as a non-fund based credit. But remember, whatever the non-fund based credit can be converted into the, see, non-fund based credit can be converted to the fund based in future date. See, it may result in the transfer of the money to the beneficiary of a commitment at a future date. That means non-fund based can be converted into the fund based in a future date. For example, say here say bank guarantee, bank has given a guarantee that this customer will pay, right? But if customer doesn't pay according to the guarantee, bank has to pay. So at the end or in the future, non-fund based credit can be converted into the fund based. Okay, letter of credit, when we have to discount that letter of credit, when we have to settle the transaction, that time we obviously the bank have to pay, right? And that means we can say non-fund based credit can be converted into the fund based credit. Okay, now here we come to know there are basically two types of credit. First is fund based and second is non-fund based. Now next we will discuss, see here is a diagrammatic representation, you can easily understand. See, type of credit, there are two types basically. First fund based credit and simply second non-fund based credit. So here see, non-fund based credit example we have discussed: bank guarantee, then letter of credit, co-acceptance of the bill, deferred payment guarantee, forward contract, derivative. These are non-fund based. Okay, so remember friends, here derivative is also the non-fund based. Now fund based, again we can have a classification depending on the purpose or depending on the period. If it is depending on the period, it may be short term, it may be a long term. If depending on the purpose, we can classify that is a working capital finance, project finance, export finance, crop loan and other. Okay, gold loan we can classify. Okay, so in this chart you can get a better clarity about the what are the main two types of credit. First is the fund based, second is a non-fund based. Non-fund based having different type of examples. Fund based further we can classify depending on the purpose or depending on the period. If a period is involved, we can say short term and long term, but when the purpose, based on the purpose, we can say working capital finance, project finance, export finance, crop loan, others. So in this way we can classify. Now what we have to discuss is the components of the credit management. What are the component of a credit management? So basically how the credit management function in the bank. So it have the loan policy of the bank. Every bank has its loan policy, and RBI has given a permission to the bank that their BOD can formulate the loan policy. Okay, every bank has an independent loan policy. Next, loan policy of the bank first, then there is a credit appraisal, delivery, that is a credit delivery of the credit, control and monitoring of the loan or credit, rehabilitation and recovery, credit risk management and the refinance. Okay, these are the some components of the credit management. So basically how the overall loan or a credit or advance goes through from initial to the last step. Basically this is the component of the credit management. First, board of director will have some loan policy, and if a customer approaches, we should have credit appraisal should be there. Then credit delivery means basically a disbursement, then controlling and monitoring of that loan. Then if the loan is not able to repay by the customer, then there should be the rehabilitation recovery. Then if there is a risk, then we have to do the credit risk management procedure, and we should have the basically the credit risk management, and in the last we can have the refinance also from NABARD, RBI, CDB, right? So these are the basic components of the credit management that we will discuss one by one. Okay, so loan policy of the bank. First, see, loan policy of the bank. Every bank formulates and develops its own loan policy based on the factors like market condition, policies of the competitor, bank's own SWTO analysis and RBI guideline. So basically first you just remember here that loan policy, every bank has its own loan policy. Say SBI having its own loan policy. See, Union Bank of India, it's have its own loan policy, and say Central Bank of India is also having its own loan policy. And how can say CBI will form the loan policy? Loan policy, CBI will study the loan policy of SBI, UBI, right? Again, CBI will go to study the what are the guidelines of the RBI, what is the market condition, whether there is a corona situation or not, whether there is any pandemic, whether there is inflation, all that is being considered. Also, one thing here is considered while having the loan policy is the SWOT analysis. SWOT analysis means S stands for the strength, W stands for the weaknesses, and O stands for the opportunity, and T stands for the threats. Okay, so SWOT analysis means nothing, simply it is a strength, weakness, opportunity and threats in the market. Okay, so SWOT, remember the full form, SWOT analysis. What is SWOT analysis? It is a strength, weakness, opportunity and threat in the market. Okay, so banks should have its own SWOT analysis, as well as the bank should study the market condition, what is the competitors policy, also RBI guideline, and based on that bank can design its own loan policy. Now, the following aspects are included in the loan policy. First, exposure limit to the single borrower and a group, that is specified in the loan policy itself. Exposure limit for individual sector may be specified, for example real sector, steel sector, industry or any other industry, that can be specified in the loan policy. And discretionary power at a various level for sanctioning the loan, that also explained or given in the loan policy. That means scale 2 manager will sanction the loan up to 10 lakh, scale 3 manager have a power of say 25 lakh, scale 4 is having a power of say 60 lakh, scale 5 is having power of 2 CR. Okay, this is just for your understanding, this is not actual powers, right? So what I have to say, there are, and where that powers has been given, power is specified in the loan policy of the bank. Okay, single exposure to the single borrower means for only one borrower, one person, how much you can lend money. Exposure to the group of people, how can you lend to the money or a company. Exposure for individual sector, like you can define the sector, like real estate, I have to give the loan say 20% of our capital. Okay, this can be explained in the loan policy of the bank. Okay, so bank develop its own policy, right, depending on the different factors, like what is the market condition, what is the policy of our competitors, banks SWOT analysis, that is a strength, weakness, opportunity and threat, and also RBI guidelines should be considered. Okay, this is all about the loan policy of the bank. Now, what is the credit appraisal? So friends, we all know what is a credit appraisal. We are working in the bank, right? So here we will discuss the credit appraisal. See, credit appraisal is a process by which bank appraises the technical feasibility, economical viability and credit worthiness of the borrower. What is the credit appraisal? See, if the customer approaches a bank, whether the customer demanded a loan of say 100 CR, whether the bank will directly give, bank will do the inquiry whether that what is the purpose of that loan, whether the customer is going to repay that loan, what is the status of that person in the society, whether it is a default in other bank, what is the CIBIL score, that also we are checking, what the collateral is able to provide by the customer, we are checking. Which means basically we all do the analysis, all background check, all thing we do about that customer, then we recommend it for the sanction. Okay, so basically these steps which we do before sanctioning the loan, simply it is a credit appraisal. Okay, now see, theoretically, see, credit appraisal is the process by which bank appraises the technical feasibility, economic viability and credit worthiness of the borrower. Bank assesses the ability of a customer to repay the loan. Bank analyzes basically whether the customer is able to repay that loan. Bank determines whether borrower is a credit worthy or not. Bank also check the background of the customer and also history of the borrower. Bank also look into the feasibility of the project for which customer demanding the loan, and the bank also looks the value and sellability of a collateral provided. That means if the customer doesn't repay, then bank also check that whatever the collateral fee is provided by that customer, whether it is a sellable, that means whether we can sell that or not. Okay, that also checked before giving the loan. Okay, so this is basically the credit appraisal. Whatever the steps we do before sanctioning the loan, simply what are all are the credit appraisal. Okay, now we have sanctioned the loan. Now next step is delivery of the credit. Simply delivery of the credit means simply disbursement. Simply in word you can remember, in short, delivery of the credit means simply disbursement of the loan. Okay, now see, the delivery of the credit refer to the documentation and creation of a charge over security, method of a delivery, and the procedure for disbursement of the term loan. So what is the delivery of the credit? Delivery of a credit refer to the documentation and charge creation over security. See, delivery of the credit means first disbursement. Disbursement means basically you are delivering that credit. Okay, so in a simultaneously what you have to do, you have to create some charge. For example, customer has given some land or a property as a mortgage, then we have to do the RM, that is register mortgage, or any type of mortgage we have to do. We have to take that mortgage and we have to register with the register of the companies or anywhere. Simply here what I have to tell you, see here, when we are going to disburse, we have to do some documentation, and the documentation means simply say mortgage, that is say charge creation. In simple words, we are creating the charge. If the land is given, if the farmer is giving a land as a collateral, then on the 712 there is the document for their land. On that we are having what, we will have the name of our bank, say Bank of Baroda. Okay, BOB name will be there on the 712 of that land. Okay, that is a document for the land. Basically the documentation and creation of a charge over the security, method of a delivery, how you are going to deliver the credit. By NEFT you are transferring fund, directly disbursing that fund into the account, or you are giving the DD. The procedure of disbursement of the loan, that is basically the delivery of the credit. Okay, what is a credit delivery? It involves your documentation. There is a necessary documentation for the simply for the purpose of disbursement. That is mainly involve the charge creation, then actual transfer of a fund. Okay, so that is basically the simply delivery of the credit. Now what is a credit control and monitoring? Control and monitoring refer to the credit control and monitoring. Obviously when we give the loan, when we given the loan to the customer, definitely we have to monitor that loan. We have to monitor that loan whether it become in the category of SMA1, SMA2, or it will become NPA. We have to observe so that in early stages we will avoid that loan from becoming NPA. Once it become NPA, bank has to do the provision. So which is loss for the bank. So before the loan become NPA, we have to monitor so that we can avoid the future losses for the bank. Simply that is nothing but the control and monitoring. Control and monitoring is necessary. Monitoring is necessary so that bank can take action to reduce the chances of the default. Okay, that's why simply we need a control and monitoring. Okay, that is basically in different banks having a CAD department, that is a and also having the transaction monitoring department that basically monitor the transaction. But here specifically for credit monitoring, we should have the different department. In every bank there is a department for a credit monitoring. For a credit control and monitoring, there is a separate cell, there is a separate department who generally observes the different loans. The branches accordingly will get the notified. The list will be given to the banks whether the loan is in which category, that is in SMA1, SMA2, okay, or whether is on the verge of becoming NPA. So before that all lists were given to the branches so that bank can take a follow and avoid that loan from becoming a NPA. So simply that is all about the monitoring and control of the credit. Now what is a rehabilitation and a recovery? What is a rehabilitation and recovery? See, there are a chance that a borrower will default. There is a chance that a borrower will default due to the business problem or maybe willful default. When a reason of a default is a genuine, bank assess the feasibility of providing additional assistance in order to make its operation viable again. This is called the rehabilitation. Simply name itself, it is a self-explanatory rehabilitation. See, person who have customer who have taken a loan, say 100 lakh rupees, and due to the pandemic, due to say like a corona situation, due to the pandemic he is not able to repay their EMI on time. So there is a significance that due to the pandemic his business get harmed. That's why he is not able to repay. So it is a genuine case. It is genuine case, right? So in such a way, in such a situation, bank will have to analyze that, and a bank can do the what additional assistance. Bank will provide the assistance. Okay, bank will either do the restructuring of the loan, or bank will have to give some package as per the announcement from the government. Okay, so this is basically the rehabilitation process, right? And if the customer is taken, say a customer like a Malya, say a customer here is the Malya and had taken a loan of say 10,000 CR, and he run to the London. So it is not the rehabilitation process. He willfully defaulted that loan and fly away from the country. That's why it is not possible that we should assist the Malya, because he has now fly away from the country. That means he is intentionally defaulted the loan, willful defaulter. That's why we have to start in such a cases the process called as the recovery by the way of any securitization act, by the way of selling his asset. In this way, if the willful defaulter, then definitely bank will go for the recovery. So here, what is the difference between rehabilitation and a recovery, that you should understand. Okay, we have discussed rehabilitation and recovery. I repeat again, there is a chance that borrower will default due to the business problem or the willful default. When the reason of a default is a genuine, bank study the feasibility of providing additional assistance in order to make operation viable again. This is simply the rehabilitation. But when the rehabilitation is not considered, that means in case of a willful default, bank execute the process simply called as the recovery process. Okay, recovery, we all know, when a loan become NPA, we start recovery. Okay, by different we are using different act like a securitization act, sending notices, selling the collateral. Okay, in this way we start the recovery. Now credit management. What is a credit risk management? See, we have discussed in a detail what is a credit risk management, what is a risk management also, that we all have discussed, right? So what is a credit risk management? Simply, credit risk is one of the major risks faced by the bank. Obviously, when a bank gives some money to the customer, bank have chances, bank have a fear that whether that customer going to repay or not. That is simply the credit risk. Whatever the loan, say 100 lakh rupees of loan bank has given to the customer, so bank always has a fear that whether we will get that money our back or not. That is simply the credit risk. Whatever the credit you are giving to the customer, you are having the risk that whether we are getting that money or not. That is simply the credit risk. Okay, bank needs suitable policies in place to identify, measure and control risk within the acceptable limits. So in such cases, what bank should have? Bank should have a standard or suitable bank risk management policy, so that bank can control that risk, risk, and bank should control that risk in such a way that it should be within some acceptable limits, so that bank's function will continue. Bank will not go into the bankrupt. Okay, this is all about the credit risk management. Now refinance. What is the refinance? See, in times of a tight liquidity position, means what? See, bank have a say 100. What is liquidity? Basically, we have discussed a lot of time, right? Bank has a say 100 lakh rupees of a deposit with the bank, and out of that, bank has given the loan of a say 90 lakh rupees. So bank only have the 10 lakh rupees. That means basically when the liquidity position is tight, means bank have no money. When the tight liquidity position means bank have simply very less money or no money. Bank have norms to avail the refinance from a NABARD, from a CDB or RBI. Simply, who will provide the refinance? Here, the NABARD, CDB or RBI will providing the refinance to the banks. With respect to what? With respect to the priority sector advance. With remember here, the NABARD, CDB and RBI all can provide bank refinance. Bank they will provide the refinance, but with respect to what? Only the priority sector advances. What is the priority sector advance? That we are going to discuss in detail, but here just remember. For example, say I will explain you. Agriculture is a priority sector, and in that bank has to lend at least 18% of the total loan. Means bank have suppose 100 rupees of a loan, out of that 18 should be given to the in agriculture sector. This is the rule of RBI. Okay, so if bank has 100, out of that 18 is given to the agriculture sector, and remaining say 72, right? Remaining is 82 is given to the other sector like industry. And bank is now having a problem of liquidity, so bank will go to the either NABARD, CDB or RBI, and they will ask, bank will say that as per your rule I have given agricultural loan of 18 rupees, that is 18% to a party, to a farmers, that's why there is a problem of liquidity. Now then NABARD, CDB or RBI will consider the request of a bank and say, okay, it is as per our direction. So how much you are given to the agriculture sector? 18. So we will give you 18 rupees as a loan again. That is a refinance. Okay, because you are having some problem, and this problem generated to the our guidelines. That's why that NABARD, CDB or the RBI will give the same amount or there is some margin as a refinance to the bank, so that bank can have some liquidity. Okay, this is all about the refinance. Now you have to remember here one line: the risk still remain with the bank even after refinance. That means if a bank has given a loan of say 18 rupees as agriculture advance, and bank need money, then bank can get some money or some advance from RBI, CDB or NABARD. But whatever the risk that you have lended in the agriculture, that always lies with the bank. In a refinance, the risk is not transferred. The risk is not transferred. Okay, that is very important line that you should understand. In a case of a refinance, the risk lies with the bank itself. Risk lies with the bank itself. Okay. Now, what is the role of a RBI in case of the bank's credit management? Basically, we have discussed bank credit management. How RBI influences the bank's credit management? So, see, RBI has a direct influence on the credit management of the bank, and there are some important of RBI guideline regarding the credit management. So, what are the RBI guideline about credit management? Here we will discuss. So before discussing, here you can see the slide. Role of RBI in a bank's credit. That means how RBI has given direction for the different loans. Simply, first RBI say you should ensure, the bank should ensure the for what purpose the loan is being used. That is the end use of the fund. Then there is some guideline about the priority sector. For example, agriculture, weaker section, MSME, right? For different sector, RBI has a guideline that you should mandatory lend some money into that sector. Okay, that is basically priority sector means. What is the priority sector means? It is a mandatory learning. It is a mandatory lending. Banks have to lend money to that priority sector. Okay, that is a priority sector lending. Then there is a MSME Act 2006 that we are going to discuss. Next, credit exposure norms has been given by the RBI. Interest rate on lending also given some guideline by RBI like MCLR. Then what is the collateral security should be taken on the loan, and in which loan it is waived, that is guideline given by the RBI. What should be the monetary and credit policy? Obviously it is decided by the RBI, and we know monetary policy of RBI is published after every 2 months. Remember, monetary policy of RBI is generally published after every 2 months. That is in a year 12 times. It is 6 times in a year, 6 times in a 1 year. Okay, remember here one beat, monetary policy of RBI is 6 times in what, in 1 year. Okay, 6 times. And RBI restrictions on bank, RBI has also imposed some restrictions on the bank, that is you cannot do this thing, you cannot do this thing in case of loans. Okay, that all things we are going to discuss in the way of what is the role of RBI in the bank's credit. Okay, so let's start one by one. First, end use of the fund. See, the primary responsibility of the bank is to ensure proper use of its fund. For example, say there should be no diversion of the working capital finance for purchase of fixed asset. What is end use of the fund? End use of the fund means, say if you have taken a loan, if you have availed a loan for the purpose of say housing loan, and from that money you are investing to buy agriculture land for the purpose of farming. So this is the diversion of the fund. So the end use of the fund is not insured here. For example, say you have taken a loan for say car loan. You have taken a loan for a car loan. You come to the branch and you said, you give me the, I have to buy the BMW of or say Rolls Royce having a 4 CR worth. So give me the loan. So bank given that 4 CR loan, and from that he purchased a property. So this is not ensuring the end use of the fund. Simply it means that whatever the loan, whichever the loan bank is giving, bank has its responsibility itself, bank's responsibility, that end use of the fund should be insured by the bank. Okay, simply. So next, what is a priority sector? Priority sector, following is the list of a different category in the priority sector. See, we are having different sectors. For example, say industrial sector, agriculture sector, different sector. So bank has to give loan to the all sector, right? But in that sectors, RBI has identified some sector, so that should be treated as the priority sector. Means while giving the loan, priority should be given to that sector. Simply, priority sector means while giving the loan, priority should be given to that sector, so that they have some importance in the economy. Okay, and what are the priority sectors? See, agriculture, it is a priority sector. MSME, it is a priority sector. Credit export, it is also the priority sector. Loan in the education is also the priority sector. Housing loans are a priority sector. Social infrastructure is also in the priority sector. Renewable energy is also in the priority sector, and there are some others which we are going to discuss. Okay, so for here, what is a priority sector? Priority sector is the sector where bank have some RBI mandatory guideline that bank has to give loan to that sector on a priority basis. Okay, and it includes what? It includes your agriculture, MSME, export credit. Why export credit? Because whatever the things you are exporting from say India to say USA, say India to USA, then exporting you will get the foreign currency, and that is a very helpful for development of the country. That's why it is important. That's why RBI has given that export credit should be given, and so that exporter will get promoted, will get more motivated for the export. Okay, so that it will benefit for the nation. For education, it is also in the priority sector. Housing loans in the priority sector. Social infrastructure, like you are having some doing some loan, giving loan for the public utility, that is social infrastructure, like a health center and all, right? Then renewable energy, you are having some solar plant investment. Okay, that is also very good, right? That's why it is also in the priority sector, and there are some others which we have to discuss. So these all basically the about priority sector. Now there are some targets. Which are set by the RBI. That RBI say that whatever the sector we have discussed here, see, these are the priority sectors. These are the priority sector. Okay, these are the priority sector. RBI says that bank should lend to that money. The loan should be given to the priority sector, that all sectors. But there is some target. Set by RBI. You should give minimum that loan to that priority sector. For example, if you are giving total 100 loan, 100 rupees as a loan you are giving, then out of that 100 rupees, 40 rupees loan should be given to that priority sector. That means priority of should be given. That means out of 100 rupees, 40 rupees loan should be given to these priority sector. And this is the standard guideline from the RBI. Okay, so here are the some targets of a priority sector targets which we are going to discuss. Okay, so here we will stop, and remaining part we will continue in the next lecture. Okay, so the targets and all that figures we are going to discuss in the next lecture. Here we will stop. So before that, do one thing. You have to subscribe our YouTube channel. There is a YouTube channel by the name of Bankers Zone. You have to subscribe Bankers Zone. Next, you can download the Android application. There is Android application on Play Store. Remember, there is a Android application on Play Store by the name of the Bankers Zone CAIIB. By the name of Bankers Zone CAIIB, there is Android application on Play Store. You can download that app for the study purpose. And also there is on a Telegram application, there is our study group for CAIIB. The name on Telegram group is CAIIB Bankers Zone. Okay, this is the name of group on Telegram. You can directly join our group for a study purpose. It is an open group for open to all. And if you are joining the group on Telegram, you can directly search on Telegram @CAIIBBZ. If you directly search on the Telegram @CAIIBBZ, you can directly find our group on Telegram for study. So friends, don't forget to subscribe our YouTube channel. Also download the Android application and join the Telegram group. So friends, remaining part we will continue in the next lecture.